Welcome back to the Neuro Finance Masterclass. We are on day 53 of our Explainers series, and today we're unlocking the architect's cheat code, tax loss harvesting. Over the last few days, we've been meticulously constructing a bulletproof portfolio and dialing in our risk management. But, we need to pause and face a hard, undeniable reality. Nobody, and I literally mean nobody, not even the most elite institutional investor on Wall Street, has a 100% win rate. Eventually, no matter how solid your research is, you're going to buy an asset that goes down, and it's just going to stay down. It's an unavoidable part of the game. But what separates the amateurs from the masters isn't whether or not they take losses. It's exactly how they react when those losses happen. So today, we're going to learn how to completely flip the script on losing trades.
Okay, let's dive into this. When a trade goes south, the psychology of wealth really comes into play. Think about the amateur mindset for a second. The amateur investor holds on to a losing stock for years, honestly, just out of pure ego. They watch the red numbers pile up, but they refuse to sell because they're hoping, praying really, that it'll somehow bounce back. Why? Because selling means admitting defeat. It means admitting they were wrong. In neurofinance, we recognize that ego absolutely destroys wealth. Now contrast that with the architect mindset. The architect doesn't ignore their losers, and they definitely don't hide from them. Instead, an architect strategically weaponizes their losses. They use them to build a stronger financial fortress.
So what does this all mean? How do we actually execute that weaponization? Well, Wall Street professionals use this brilliant, completely legal, and highly sophisticated maneuver known as tax loss harvesting. To really grasp this concept, you just need a basic understanding of how the government treats your money. When you sell an asset for a massive profit, the government eagerly steps in and taxes you on those capital gains. But the tax code actually has a mirror image built right into it. If you sell an asset at a loss, you generate a documented capital loss. Tax loss harvesting is the deliberate, strategic act of selling your losing investments to generate those exact capital losses, because they mathematically cancel out the taxes you owe on your winning investments.
And this brilliantly illustrates how it works in practice. Let's look at a theoretical portfolio. Say you made a fantastic move generating $10,000 in profit from selling Apple stock. In a normal scenario, you owe capital gains taxes on that entire 10 grand. But let's say you also have a terrible altcoin position just sitting there at a $4,000 loss. The amateur? They cross their fingers, hold onto that sinking altcoin, and proceed to pay full taxes on the Apple profit. The architect, though? The architect takes decisive action. They click sell on the Apple stock for the profit, and they also click sell on the altcoin to intentionally harvest that loss.
Let's look at the immediate mathematical result of that decision. $6,000. That is the architect's new taxable profit. By clicking sell on that altcoin and formally accepting the $4,000 loss, the architect applies that loss directly against the $10,000 Apple gain. Now, the architect only pays taxes on $6,000 of profit. They didn't lose any more money than they were already down, but by legally realizing the loss, they just saved themselves thousands of dollars in actual cash that would have otherwise gone straight to the tax man.
The absolutely crucial point here is this. We're completely reframing what a loss actually means in your portfolio. You're taking a financial mistake, a trade that simply didn't go your way, and actively turning it into a strategic deduction. Instead of letting a bad investment sit in your account mocking you, you extract tangible mathematical value from it. You're using the very rules of the game to create a powerful tax shield for your broader empire. It is incredibly strategic, and let me tell you, it's deeply empowering once you master it.
However, we need to shift gears for a moment because you cannot execute this strategy blindly. There is a critical guardrail in place known as the wash sale rule, and you absolutely must know this rule to execute this maneuver legally and effectively. The government provides you with the benefit of tax loss harvesting, sure, but the IRS wasn't born yesterday. They will absolutely not let you fake a loss just to grab a quick tax deduction while keeping your exact same portfolio intact. The wash sale rule is strict, and violating it means all that strategic planning goes right out the window.
Let's move to this timeline and see how this builds. Timing is everything here. On day 1, you make the strategic decision to sell your losing stock to harvest the tax deduction. But immediately you enter a danger zone spanning days 2 through 30. During this 30-day window, you cannot legally buy that exact same stock back. If you try to cheat the system by selling it for the tax break on Monday and buying it right back on Tuesday, the IRS completely cancels your tax deduction. You're back to square one. You have to wait until day 31 before it is legally safe to rebuy that specific asset. In the meantime, if you want to maintain your exposure to that market sector, you just park that money into a different but somewhat similar asset.
All right, so here's your highly strategic cognitive task for today.
Step 1. Audit your portfolio for dead weight. Look objectively at the red numbers. Step 2. Determine if the fundamental thesis of that investment is broken, exactly like we discussed back on day 48 of this explainer series. If the reason you bought the asset is no longer true, there's no reason to hold it. Step 3. If the thesis is broken, execute the architect's cheat code. Sell the asset to intentionally harvest a tax shield for your empire. Recognize that selling isn't a defeat, guys. It is a calculated, empowering opportunity.
I want to leave you with this final, highly personal question to ponder as you review your accounts today. Do you have investments sitting at a massive loss right now that you're holding just out of stubbornness or ego? Are you paying unnecessary taxes on your winners because you're too afraid to admit you were wrong about your losers? Stop letting your ego cost you actual money. Adopt the sophisticated mindset of the architect. Audit your portfolio and take immediate, calculated action. Think deeply about that as you review your assets today. We'll see you in the next explainer.